Hi, everyone. Welcome back to the last session of the first day of the second annual Vacation Rental Data and Revenue Management Conference. We're heading into part 2 of the data session that we started this morning. And the reason we divided these up into 2 days was because of time zones. Normally, if we were doing this in person, we would all be in the same time zone at the same time. But right now, that was redundant. I'm tired. But because of this, we really wanted to spend the first session talking about the East Coast and the second session talking about the West Coast. So what we're going to do is look at the hotel data again, look at the broad data that's coming in from OTAs, and then try to narrow down some of these local destinations to try to tell the story of what 2020 has been in the vacation rental industry up against the hotel industry in data. So Patrick, welcome back. Thank you for joining us again. And I'm just going to turn this over to you.
Thank you, Amy. And if you could just allow me to share my screen. Perfect, there it is. All right, Amy, can you confirm that you can see my slides?
I can.
Wonderful. All right, well, Amy, thanks for having us back for this double header. You started your day with me, you get to end your day with me. I don't know if that's a good or bad thing.
It's a great thing.
Forward. Good. All right, so like Amy said, today we're going to get a complete view of accommodation performance in some key regions. And I'm here to kick things off with a look at hotel performance to set the stage and provide some context. To do that, I'm going to give a brief introduction into who STR is. When we say STR, it references our company, which was formerly Smith Travel Research. I know you'll see this acronym referred to at other points in the presentation. In that context, it's short-term rentals. Then I will give you just a quick look at the global view of performance here, because COVID-19 has really been unprecedented in a number of ways, and you can only appreciate that when you start that high up. We'll spend some time looking at US hotel performance, and then we're going to close things out looking at some specific markets for you all. All right, who are we? We're STR. We are the world's largest accommodations provider in the marketplace, and we've been doing this for longer than anybody, reporting on performance for nearly 4 decades now. We currently collect daily, weekly, and monthly data from more than 67,000 properties in 180 countries around the world, which does represent the world's largest source accommodation performance sample. We are a global data benchmarking, analytics, and marketplace insight provider. And I just wanted to highlight again that all of our data does come straight from the source. In other words, we don't source or we don't scrape anything. So this is all audited financials that are coming in from submitted manually or from direct property feeds, allowing us to give unparalleled visibility into property performance. Second thing to know about us is that confidentiality is a core tenet of what we do. We never, ever, ever share individual property performance data to anyone but that property. The data I'm going to show you is reported only in the aggregate so that we don't isolate performance of any one company or property. And lastly, just to point out, we're a neutral, unbiased source of data. We don't own or operate any hotels. We don't own or operate any short-term rentals. And we don't tell you how to price. What we do is give you a lot of good data to help you make smarter decisions at the property or portfolio level. One last thing, I want to talk to you about the building blocks of our data so you understand the slides that follow here. We collect a lot of information, but at its core, we rely on 3 simple data points. On a daily, weekly, or monthly basis, we ask our providers to send us supply, which is the number of rooms available in a given period. We also ask to understand how many of those rooms have been sold, and that's our demand figure. And then last but not least, we ask for revenue to get a sense of how much money are you making off the sale of those rooms. By looking at demand over supply, we understand occupancy. So that's the percentage of rooms that have been sold in a given period. And then by looking at revenue and demand, we can get a sense of what is the average price point at which a room has been sold. Last but not least, at the top of this nifty pyramid is revenue per available room, which factors in both occupancy and ADR, so you get in one KPI a good holistic understanding of performance within a market, your portfolio, or your property. With that preamble out of the way, let's look at some of this data. So to understand how COVID-19 has devastated the global hotel industry, it helps to level set a bit and understand what performance looked like at the beginning of the year. So this slide is showing you a 7-day average of hotel occupancy across every submarket that STR tracks around the world. The chart's pretty clear, I think. Red is bad and green is good. Red means less people are staying on property. You see some red, a bit of orange here. That's pretty normal for the first week of the year. When hotel performance slows down a bit during the holiday period, there's a pause in corporate and group travel. So this is pretty standard. If you then fast forward 4 months, and for most markets, this week ending April 4th represents the COVID-19 low point. And I think it's pretty clear here that across the board, there's a lot of red. I mentioned the word unprecedented previously when talking about the impact of coronavirus on what the impact it's had on the hotel performance. And when I say unprecedented, I'm speaking both in scale, that is the global uniformity of this impact, as well as the severity. Again, in our 4 decades of tracking hotel performance, we've never seen such widespread declines, and we've never seen declines of this severity. And that will become clear in some additional slides here. The good news is that if you fast forward more recently to the week ending September 5th, things are moving in the right direction. The majority of the hotel industry is hovering between that 25% to 50% occupancy bubble, but we do have some markets that are finally moving north of 50%, which is very good news. I can tell you this is still well off of historical averages. Typically at this point in a given year, you would see most markets in that light blue and then a lot of them in the darker green. So we certainly have a long way to go. This is giving you a sense of that occupancy progression over the past several months in 3 key regions. First, there's China, which felt the impact of coronavirus before anyone. So they felt their occupancy dips first, but they have been steadily and more quickly recovering compared to other regions. Counter to that, you see US and Europe hotel performance. Once end of March hit, performance really dropped off a cliff, and we have been struggling to crawl back from that low point. The good news, though, is that while performance is still low, at least the numbers are finally trending in the right direction. They're moving up. They still have a long way to go up, but at least they're moving up. And then just to paint this picture one other way, this is showing you all of the world regions we track. And again, it's very clear here the extent to which demand is down for the first 7 months of the year compared to that same period in 2019. In most world regions, demand is down more than 50%, which again, we've never seen before. And then additionally, you're seeing decreases in supply, which quite frankly doesn't really happen like this in the hotel industry. Typically, if a hotel closes, there's another 1 or 2 new properties ready to open. So supply rarely, if ever, dips into negative territory. But given all the temporary closures, some of which may become permanent, we do see occupancy down or supply down across the board. Just a quick plug here, if this interests you and you want some more insight and analysis about COVID-19, feel free to visit our webpage. Right there on the homepage, you'll see that button for COVID-19 updates. We're frequently posting analyses, blogs, white papers. We host webinars, and all of that and more is accessible there. All right, so that was the world. Let's spend more time in the US. When we're talking about US performance, we always start with this chart because this is the foundation of everything. It's Econ 101, supply and demand. Supply is in the pink line. You see the dip that we've experienced, and demand is in that dark purple. Again, it's pretty clear what COVID has done to this industry. You'll notice that the most recent decline is well below what we experienced during the saving and loans crisis in the early 90s. It's well below what we saw in the aftermath of 9/11 when travel really came to a halt. And then it's significantly worse than what we felt in the global recession. Each one of those downturns were precipitously more difficult for the hotel industry to get through, and yet none of them even compares to what we're currently dealing with now. That impact, the interplay between supply and demand, is what drives occupancy performance. And again, no surprise here, occupancy, like demand, like supply, is pointing in one direction, and that is down. Let's try to put a positive spin on this data. I feel like I've been reporting a lot of bad news. If I'm putting my optimistic hat on, it's looking at a slide like this. So this is average daily rate for the total US industry for the first few months of the year. We are still reporting year-over-year decreases, meaning that July of this year was down 24.8% from where we were in July of 2019. The good news, though, is that these decreases are getting less bad. After you saw that COVID low point in April, we're still going down, but each subsequent month, that pain is getting a little less severe. We're hoping this trend line continues, and we're hoping that before long, we will right size and be back in positive territory. That it doesn't only go for ADR, it goes for RevPar here, where you're seeing a similar trend line, April representing the low points, and each subsequent month, it's bad, but it's a little bit less bad. So this is the total US on a month-to-month-to-month basis. This slide here is just showing you July, and it's breaking up the total US hotel industry by class. At STR, we group hotels into different classes representing luxury at the high end to economy at the low end. And the classes are separated generally around average daily rate, some property attributes, and other information.
I'm going to interrupt you here, Patrick, if you don't mind.
Sure.
Now that we've looked at some of this on both sessions, from this morning, some of this is the same. And now that I've got to see all of it, I think it's interesting. Jason, are you on? And Scott, can you guys?
Yeah, sure are.
When you looked at this slide, you looked at what's going on in the vacation rental industry. Basically, it's kind of, is it not the opposite story? Is that what I'm hearing? Is it actually in the vacation rental industry, the more affluent, the better they're doing?
Yeah, it's a great question, and I'm glad you brought it up. It's the opposite, but it's an opposite for a reason that makes sense. And I think Patrick and I together can probably answer it. If I understood Patrick's point this morning from a hotel perspective, the drop in the high end comes from the absence of business travel. And I think if you looked at just leisure travel within Patrick's data, and I'll leave it to him to define that. Like, for example, when you look at his Labor Day data, I would be curious if you saw the same difference amongst just the hotel leisure travel, where you saw a harder hit from the affluent markets. Because you're right, Amy, in the vacation rental space, the logic plays a little bit more true to what you'd expect. People with more money have been able to travel more, and so we're seeing properties in affluent markets doing better. But we're really at leisure travel. So my guess is that's the difference. I don't know if that's the way you see it as well, Patrick.
Yeah, I think you really hit on it. When you're looking at what's the cause for this drop in the high end, you're right. A lot of it is corporate travel, which effectively has been put on pause no matter where you look. The other big component is group business, which drives a lot of the demand in the higher end properties. I mean, you're not going to get a ton of massive group business in the economy and mid-scale properties where they just don't have that kind of facility on property. So that's really the main driver. When you look at hotel performance across the board, what has been driving the recovery, if you could call it that, it's really been a leisure story across the board. So leisure is going to populate and mitigate some of the dips at the lower end. And they're still seeing leisure business at the high end, but the high end properties, again, they're just disadvantaged because a major source of demand too, really, corporate and group has fundamentally disappeared.
Yeah, that makes sense. I mean, 400 of us would have been at the Gaylord instead of online for this show.
Yep.
Okay. I'm sorry. Thanks for letting me in.
Yeah, thank you. So we kind of saw where it's getting hit the worst, and here you see it in a different way. Mid-scale and economy hotels at least can say they've hit the 50% threshold in occupancy, but let's not try to look at this with rose-colored glasses. No matter how you look at it, performance across the board in every chain scale is down significantly. So it's something that every class is dealing with, the dip of where they were last year at this point in time. And that's true with ADR as well. So you see 2020 performance for July, which is down effectively, let's call it $20. in every single class you look. With the drop in demand, pricing power begins to erode, and hoteliers just aren't able to charge the rates that they were previously. So that was where we were. This slide is looking ahead. So this is our forecast of what we expect. No surprise here, the remainder of 2020, it's going to be challenging. So we've never forecasted numbers like this. We hope never to again. But no matter where you look, occupancy, demand, ADR, RevPar, it's really down significantly. The good news is those numbers start moving in the right direction in 2021. So we do see significant rebounds in a lot of these areas. However, while significant, they're not enough to get us back to where we were. And what we're seeing in a lot of our markets and a lot of what we're forecasting, it's going to be until 2022, 2023, 2024 for some markets to get back to where they were in 2019 before COVID reared its ugly head. All right, so last thing here, quick look at some markets. Jason, I think you alluded to it before. When we're looking at Labor Day performance, we did see a nice little uptick. So this is demand on a week-to-week basis. We're not seeing the same week-over-week in like pickup the past couple of months that we did in May, June, and so on and so forth. So we have a concern that, I don't know, if leisure travel's been driving this ship and school's back in session, it's going to be harder to take the kids out on the road. Does that mean that we're going to plateau or hit another challenge? That could be the case, but for right now, we're just celebrating what happened on Labor Day, where occupancy at the US level was 63.4%. On Saturday alone, it was 69%, which was only down 2.6% for the same period last year. So we were really thrilled to see that, as were our hoteliers, no doubt, and I'm sure most of you hopefully got to experience that lift. These are the markets that saw the biggest week-to-week uptick in occupancy, comparing Labor Day weekend with the weekend prior. And not surprising here, where we felt that biggest increase were a lot of vacation and regional destinations. I'm not going to speak too much on that because I know Jason and Scott are going to cover it. That's a key trend we've seen in the pandemic, where the urban centers have been hit worse than some of the regional and small town metros, which have benefited in some cases. And I know the guys are going to do a good job explaining that story from the short-term rental perspective. Just to give you a quick look at top 25 market performance, we've only got 6 markets over 50% occupancy. And if you look down all the way at the bottom of that list, you're seeing key market Hawaii, key market in Florida. These are normally powerhouse markets that perform well above the 50% threshold. In many cases, well above 70 or 80%, now at the bottom of the list, unfortunately. And while the hit hasn't been as significant on the ADR side, these markets are still able to generate ADRs in excess of $100. Generally speaking, top 25 market performance has really, really suffered, not surprisingly, as a result of the pandemic. So, Amy, that takes me to my key takeaways, and I'll wrap things up here. Again, just think globally. This pandemic has had a significant impact on the hospitality sector in every part of the globe. The earliest hit regions like China have made the most progress toward recovery, but every region still has a long way to go from the hotel side. And while performance in the US is less bad with each passing month, again, still a long road ahead. Many markets will not recover until at least 2022, with some lingering into 2023 and 24 as well. And finally, we saw that boom in Labor Day. So there are still pockets of optimism. There's clearly pent-up demand. It's just a matter of doing what we need to feel safe, to take the proper precautions, to move forward so that people could really make good on that pent-up demand and begin traveling again. So, Amy, I think that's a good point to pause it here, but then I think we can hand it off to Scott, if that's right.
Thanks, Patrick.
You got it.
Let me hit you really quickly. So let's see if that went through. Corinne, will you help me with that? So do you think, Patrick, do you think the hotels, are we going to see them close? Are we going to, I'm thinking about the group business. They're saying that it's not coming back for another I mean, my speaker agents for the Women's Summit are thinking that we're not having anything until next summer. I just wonder, how long can hotels last without having any business?
It's a good question. And Amy, it would be silly of me to say every hotel is going to make it through. So I'm not going to say that. I will tell you, though, that the hotel industry is very resilient. And a lot of properties have the ability to stay open and operating at occupancy levels that might be lower than what you'd expect. They're able to kind of hit the profitability they need to. The other thing I would just offer is distress in the hotel industry creates opportunity for certain buyers. So if a certain asset becomes unprofitable and it forces an owner to close it temporarily and eventually to sell it, that's creating a valid opportunity for somebody else who wants to dip their toes in the water. So we expect to see the transaction activity pick up as things start to get better, but we're not forecasting a significant decrease in closures. A counter to that, of all of the temporary closures we've tracked, and there's been thousands of them across the globe, the majority of them has since reopened, or we know that they will be reopening soon.
Yeah.
So good news from that side of things.
Yeah, one other argument I've heard for hotels not closing down is, hotels aren't convertible into much anything else. So either you've got to knock it down and build something brand new, or you keep it open and try to do your best with it. So I was talking to some other analysts, they think, there's not going to be a lot of closings because there's nothing else you can really, reutilize that asset for. So people feel pretty confident they're going to be around even at these occupancy levels, is what I've heard.
It's interesting. There's just, you think about the overbuilding of those or oversaturation of hotel rooms in some markets. I just don't, anyway, Scott, I'll hit you up in a second.
So good. Right, so
Thanks, Patrick.
Jumping in the short-term rental side of things. First off, oh my God, we're gonna have this problem again. I can't get to my new slides. All right, here we go. So anyways, we're AirDNA. For any of you guys that don't know about us, we've been around for a little over 5 years. We've been tracking the performance of every property on Airbnb and Vrbo over that time period, about 10 million listings every single day. We have, about 8,000 customers, paying subscribers in about 60 countries around the world, and have been leading the charge, I would say, on market intelligence in this space for a long time. And we think about our product as really solving a lot of the needs across this, every decision point across, finding a property either to invest in or to manage, setting those properties up for success, especially on the OTAs like Airbnb and Vrbo. How do you think about dynamic pricing? A lot of market insights and price recommendations on properties, and how do you benchmark the performance of your properties over time? Oh, this is going to drive me insane. Do you guys have any tips on how to scroll to my next slide? God, let me see what I can do here. All right, let me see. So anyways, how do we get our data? There's obviously a lot of operators in the world. Last time we counted, there's 3.5 million individual operators out there in the space. And so obviously getting access to this data, especially on a global scale, is very difficult. We've been scraping everything on Airbnb and Vrbo for about 3 years, 4 years on Vrbo, 5 years on Airbnb. That's about 10 million properties every day that we're scraping and analyzing. We also have partnerships with PMSs, large channel managers, which gives us access to the booking data across about 750,000 properties. We also have the ability for individual hosts to give us iCals and help us understand their bookings on Airbnb specifically. And so that sort of rounds out how we get all this data that we'll be presenting here in this presentation. So just thinking about sort of our agenda, just real quick hits on a bunch of different themes that we're seeing. One, we'll sort of look at the hotel data versus short-term rental data, talk about overall vacation rental performance, some changes in booking behaviors, supply trends, and what the future looks like for the industry.
So are there slides in between? Is that the deal?
I don't know what it is. It seems like I just push enter typically when I'm doing a slide. share, but I'm doing it here.
Got
Enter
it.
just gets me
Yeah, got
a
it.
do not pass go. So I'm using
2020.
my mouse scroller, which is overly sensitive apparently. So here we are. So back, I think about a month ago, we worked with STR. We looked at 27 global markets around the world and really did an analysis of what's happening, what are the similarities and differences between how hotels performing and vacation rentals. So this is the first, chart looking at occupancy across all of those markets. We see kind of the hotel in blue. We see the rentals hotel comparable. That's that HC in orange. And that is really studio and one bedroom apartments or studio and one bedroom vacation rentals, and then the larger units in green. So we can see, we all saw a dip, hotels a little bit more in that sort of March, April timeframe. But, the vacation rentals really didn't see the same sort of lows that hotels did. I think we've talked about a lot of those themes. I know, Amy, you've written about some of those themes, but, short-term rentals became midterm rentals. People ended up, sort of fleeing the cities and moving to these rural markets to sort of flee and stay in these single-family properties. And we've just seen a lot of different usages of these short-term rentals, longer stays, and people just utilizing short-term rentals in ways that we wouldn't have anticipated before, which has really driven up occupancy rates, especially on the bigger units around the world. And so also on the rate side of things, we've seen that Patrick went to the ADR on the hotel side of things. We see very similar trends on those smaller vacation rental units. They haven't really recovered to previous year numbers in terms of what their average daily rate is. I think larger units have, and they're actually charging, it's not a ton more, maybe 5-7% last time I looked, more than they were last year. As there's a lot of demand for larger units, 3-4 plus bedrooms places, and people actually do have a lot of pricing power if you have that supply. This is painful. All right, here we go. So we're gonna talk about Europe a little bit. So overall in Europe, we saw about 3 million properties last year in August. We saw a reduction of about 500,000 properties over the course of the last 6 months. It's pretty significant. It's about 17% change in overall listings. We see a similar trend in the US, which we'll jump into. But we see here about 17 million listing nights, which is the number of nights times the number of listings available in that month. So down 26%. We chalk this up to a lot of people utilizing second homes in ways they hadn't. We chalk this up to people not feeling comfortable in having strangers streaming through their homes and uncertainty in that perspective, and also just not great performance. In Europe, a lot of boundaries are closed. Movement is difficult between different countries. U.S. travel is obviously frozen up, and so there's a lot of markets that were highly dependent on people getting on planes that just don't make sense in this environment. But occupancy rate of the remaining properties has still been high, and in Europe, August is the best month of the year. Not quite as good as it was last year, but 67% occupancy ain't terrible. ADR has been relatively stable, RevPar relatively stable for those properties that are still making it through. So how does it look in the U.S.? So in the U.S., we saw last year about 1.1 million listings across Vrbo and Airbnb in the US. It's down 15%, and I think it's a story that's not told very often. We'll tell a little bit more further in this presentation, is that there actually has been a pretty significant reduction in supply. Demand, especially for these larger units, has remained fairly stable. And so we can see for these remaining 924,000 units in the US, occupancy is actually up, ADR is up, RevPar is up. It really is about this redistribution of bookings towards higher end properties, like we were just kind of mentioning before. The studio and one bedrooms are sitting vacant. Those were cheaper properties, lower ADRs, and being sort of replaced by bookings on these higher end properties. I wouldn't really call them higher end though, like in a sort of a chain scale sense. It's really larger units, right? And larger units can get a higher rate. And so yeah, we dig into this because it's so like counterintuitive that people are charging more this year. It really is just sort of the mix of the units being booked is sort of why that rate is up year over year.
So can I ask you a question here too?
Sure.
On this whole, like you're talking about the studios and the one bedrooms being up, when you're looking at these urban markets in particular, and the smaller units, do you think hotels are going to get super aggressive in the city urban markets? Like, where do you think short-term rentals end up, like let's say over the next year or two, for like companies like Sunder? I mean, we saw Stay offered in Lyric.
Mm-hmm.
You know what I mean? Like, what Domio, like, where are we headed with these?
Yeah, my honest opinion is going to be pretty ugly for short-term rentals. I mean, because the reason the short-term rentals really flourished in these big cities is because there was, 95% occupancy in some of these markets, and short-term rentals really were sort of this overflow valve for, they just needed more properties. There just wasn't enough listings in New York 5 years ago. And so it just allowed people to sort of convert properties and get this sort of overflow hotel traffic and demand. But with hotels suffering so much, they're going to sort of, I think, recoup a lot of that demand quicker. They're going to be able to price people back into their properties, and the short-term rentals are going to suffer, right? They just aren't going to have enough demand for a business traveler going to Boston for 5 days. It's going to be tricky. It's going to be very difficult for short-term rentals because they are competing directly against hotels. Hotels are going to be doing their best, marketing, pricing, everything they can to fill those beds. And short-term rentals really proliferated in a really strong hotel market. In a weak hotel market, there's a lot of uncertainty about how short-term rentals, studio one bedrooms in these top 25 markets perform. I think it's going to be what do you really want to call it, 3, 4, 5 year recovery for those markets.
So just on that same line of thought, when you look at also the shared space stuff, like rent a room, rent a guest house or whatever, do you think is that also part of the supply that's disappearing?
Yeah, I mean, so in the pandemic sort of environment, nobody wants to be in a shared room, obviously.
Right.
I think so. Obviously, that's the biggest variable for how well that sort of returns. Nobody's going to hostels at the moment. Nobody's going to this sort of shared experience, but we know that demand's there. So are they going to be able to hold out for a year for a vaccine? We know people want to travel that way. We know young people want to meet other people. It's just really a question of how long it takes for people to want to hang out with other people and be in close proximity again, which really just nobody has those answers.
Well, I think looking at the shared space taking such a hit and the short-term urban space taking such a hit, and knowing that's a big part of Airbnb's competitive edge, do you think they have anything to worry about here?
I don't think so. I mean, just because we see demand so high, we see that there's going to be a whole new area for proliferation, right? And we're looking at this real estate investing data a lot, and we just see markets in these rural areas, in these mountain towns that nobody's heard of, by a lake, or even in the desert in Palm Springs. They're seeing like 90% occupancy in August. Like, who wants to go to Palm Springs in August, right? And so what it's just going to do is just sort of change the way people are traveling, where they're going, where they're driving to, and it's just going to sort of create new hotspots where people are going to be adding supply, where it makes sense to buy or master lease a home and throw it on the Airbnb. People will follow the money, and we plan to help them figure out where that is, right?
Yeah, I think that data in the last session with Ralph showed a lot of that too, that the intent to buy is going to go up in the vacation destination. Thank you. Sorry to interrupt. I'll back
No,
up.
it's good. It's better than just running through slides twice in one day. You sort of feel like,
I just texted Jason to see if he was okay hanging out for a little bit longer. We don't have a hard stop this time.
All right. STR index. So what we'd look at here is we created an index really looking at what is the average revenue generated in the top 50 markets across the US. We segment this into 25 destination markets, which would be like your Myrtle Beaches and Hilton Heads and those sorts of markets. And we have all the top 25 cities. So I think it's pretty telling here. You know, we really see this pretty clearly. It's the destination markets saw a little hit going March, April, but rebounded and really are sort of are at like better levels than they were pre-COVID in terms of the average revenue of the, you know, now of the properties in August, how much they're earning. Think about it in sort of a year-over-year comparison. And the cities are actually recovering quicker than I would have imagined. You know, they took a big hit. A lot of supply has been reduced, and so the properties that are left are sort of inching back. We do see, you know, some hope there for the U.S. Properties, even in the cities. And so just putting some like actual city names down here, like destinations and cities that are included in that last analysis. You know, here are some of the markets that we see as top performing. We see, you know, the Breckenridge here in Colorado doing really well. I mentioned, you know, Palm Springs is doing incredible. It's not on this list. A lot of beaches in Florida are doing really, really well. And so we actually see pretty good performance. You know, even like markets like Las Vegas are popping up. And this is sort of just the weird thing that's happening. Like it is a really interesting time to look at the data, I'd say, because, you know, August, Vegas, not a popular time. But what we're seeing is just seasonality be really, really extended in a lot of markets. Anything that's within a couple hour drive of a city, doesn't matter if it's 120 degrees. We see Scottsdale doing incredible right now. And so it's just sort of changing the paradigm of like where people are willing to go. If there's a pool, they're willing to get in their car and go there, even if it's oppressive heat at the moment. And in the cities, you know, just density of these cities, just the ability to have any privacy, and you know, people are just not going there. So we see these tech centers, we see all these cities on the coast really struggling right now. And so sort of to emphasize this, I know Jason will as well, and so I won't belabor the point too much, but it really is a lot about this fly to versus drive to destination. Hopefully Jason will get into some Hawaii data because I don't have any specifics here, but they were obviously the hardest hit. Nobody could get there, nobody could leave there, but it was hit, right? And so when we look at where our drive to markets, and we looked at this pre-COVID, how far was the average Airbnb guest going to stay at a vacation rental? You know, the average for these top drive to markets with, you know, over 1,000 vacation rentals is 180 miles. And we look at the fly to markets, you know, over 1,500 miles, obviously by plane to get to these markets for the average person. And so we see the recovery for these markets has been very uneven, where revenue growth for those drive to markets has been up almost 140% from the COVID lows. The recovery is much slower for those drive to markets. All right, I'm gonna not skip that. I'm gonna go into one of these charts, hopefully. I didn't like me earlier, it's not gonna like me today. All right, we'll talk about booking lead time. So booking lead time, we saw it as sort of the biggest phenomenon that's happened really since we've been tracking this for 5 years. We've had very consistent booking lead times, sort of precipitously falling off over the years, right? It used to be over 100 days was a sort of an average booking lead time when I started first looking at this. You know, got down into maybe the high 60s pre-COVID, but really overnight what we saw is that people weren't, you know, didn't have much confidence in booking travel, obviously 3+ months in advance, but almost everybody was booking immediate stays, call it today, tomorrow, in the next week, and ended up being almost 80% of all the bookings that were happening in the depths of COVID. And it sort of slowly has recovered, but you'll still see a sort of a missing gap here, right? 91+ day travel, even as we get into Christmas and New Year's, where typically this is where we're seeing everybody book coming out of the summer, that booking activity is just not happening. And so we're seeing, you know, that this booking window has shrunk, that people aren't really booking many things outside of 30 days right now. If you look at the chart, it looks maybe like 35% of bookings are happening outside of 35 days. And so, you know, it sort of just changed the paradigm, really understanding your market, having a lot of confidence that bookings will happen, even though you were all booked for Christmas last year at this time. You know, it's going to take you another month or two to get those booked. But, you know, I wouldn't recommend sort of reducing rates by too much. It's just the way people are booking, the confidence they have to book has changed over the last 6 months. So just real quick on some supply trends. I will keep this real quick. we did see a dip of supply in Airbnb. We just saw there weren't very many properties being listed, a lot of properties delisted, and so we saw about a 12% reduction in supply in Airbnb from January. We did see the first uptick in August as more properties are being reactivated, more properties are being listed. It does seem like the supply story is starting to recover on Airbnb. And then Vrbo has seen really steady supply and actually a lot of growth in March. A lot of people defected from Airbnb, went over to Vrbo, and now it's been a pretty steady story there. Around 2.25, 2.3 million properties are there currently. Investment trends. Wish I had more time to talk about it. We're going to sort of zip through it, but we do see in this environment with less supply across the U.S., with a lot of these markets that are very affordable, rural markets in the mountains and the rivers and sort of outside of city centers. These are really affordable properties, and this is where people are choosing to stay and choosing to stay for extended periods of time. And so this is sort of a look at some markets, sort of a mix of cities and rural markets that are performing well. We're probably going to come out with something soon that really shows like where these best investment markets are. But we can see also this sort of correlation between good short-term rental investment markets and appreciation of homes in those markets. I mean, 65% appreciation in Pigeon Forge. I mean, that's an insane appreciation rate over a 4-year time period. And we see that pretty consistently in great short-term rental investment markets do have high home appreciation over time. So it's a story I'm telling often to the real estate agent crowd, broker crowd, and really sort of getting people excited about being able to be experts in their short-term rental market. I'm going to skip this market outlook. I will end on pacing. So what does the market look like today in terms of bookings? Bookings that are on the books, reservations on the books right now versus the same time, same date last year. So we can see this as a number of booked nights per week. No, number of bookings, reservations, number of reservation days each week that are on the books. So we can see, we have still pretty big gap to make up, right? Going over the next 3 months, it looks like people are starting to book that Thanksgiving holiday. There's not a huge gap there, maybe a 20% gap from where we were last year across the U.S. People really aren't booking Christmas and New Year's yet. We see a big gap there. And going into January forward, we are seeing a pretty dramatic decrease in the number of people that are booking out into next year. I'm going to end it there, give Jason his time. Thank you. Do I need to do anything here? Jason, you got it on your end.
Yeah, I sure do. Thank you so much, Scott. I appreciate it. And thanks to everybody for sticking with us here. Last presentation of a data conference. I hope if you're east of the Mississippi, you got a cocktail in your hand. And if you're west of the Mississippi, we're virtual. So hopefully you have one as well.
You have one in your hand?
I don't yet. I'm embarrassed to say, but I'm about to. I can't promise I'll make it all the way through without having one. So listen, 2020 has kicked us in the proverbial ass, and I thought it was fitting to start with a thank you, given the year that we've had. Really, 2 thank yous here to reiterate what I hit on this morning. First, just a huge thanks to Amy for the vision that we could have something bigger, and this co-op of data that we've now all kind of began to share. We're humbled by our opportunity to participate in it. And, this conference that you put on our second year now, I learned a whole lot more today than I expected. I was just talking with her before we started here. I think these panelists that question all the software providers in particular and hold our feet to the fire on our weaknesses, they force us to be better. And so thanks to Amy for keeping us trucking and kind of pointing us in a direction that hopefully will continue to create better products that serve you guys better. And then secondly, just thank you to you. I see a lot of familiar faces on here. Betsy, Derek, Kate, I hope you guys all have a cocktail. I would expect it out of you. The last 2 years, we kind of started out on this journey expecting to go down a very difficult data path of just knocking on one door at a time. And we've ended up with 1,600 property management companies that are part of this grand experiment with us. And just wanted to stop and say thanks for the data that you're contributing. As you know, we've got scrape data as well for the US, but everything I'm going to show you today is your data aggregated, and I'm going to hope to show you in a digestible format, kind of just what the story of 2020 is really, and hopefully most importantly what to expect for the next couple of months, so you can adapt your pricing strategies and business strategies to fit that. And start out here real quick with a place we start often, which is just what's going on in the US as a whole. I've got these things numbered. These are the big three. These are the ones we always talk about: occupancy, ADR, and RevPar. And we're looking at the whole year here and the delta versus last year. Hopefully very soon we'll bury 2020 in the backyard and things will start to look better in 2021. But if you look across the US as a whole, and then we'll dive into the regions here and look at some states in particular like Hawaii and talk about the differences there. But to start out with number one, we came out of the gates looking great, almost universally around the country. A good opening with January and February. We all know kind of the dismal events that punched us in the face in March, April, and May, and you see that giant dip there all the way across the board. Obviously, RevPar being a multiplier of occupancy and ADR, so even further down, negative 75, 80% there at the low spot. But then as the market started to open up, and as each region kind of lifted the restrictions legislatively, we were able to jump back in and fortunately see, per market a jump back almost to normal. And by the time we got to summer, a little bit slack off there in June still, but really, remarkably, and I don't think many places in the world can say this, or many other forms of hospitality can say this, whether restaurant, hotel, cruise, or anything, and probably not much of anything outside of the US, we had a decent summer overall as a country. It's not the case if you're in Hawaii, or it's not the case if you're in some of these markets that have been shut down longer than others, but remarkably fortunate as an industry that we were able to pull off a good summer. And then September, the last time I was in front of this group, we were hoping for a good September, kind of speculating as whether or not the kids being out of school would make the difference that we were hoping, and whether people working from home, whether you'd start to see them take advantage of it. We're seeing that. You can see that ADR is a little bit below the rest of the curve there in terms of occupancy, so a little higher demand there than what's being captured. So might be worth looking at your data and seeing if you're leaving any on the table rate-wise for the next couple of weeks, as particularly if that continues to be a trend as we go into October. I was mentioned this morning, I think parents are getting sick of kids, and more people are starting to put them back in classrooms that they were reluctant to a few weeks ago. A couple of nights of 7th grade civics homework will do that for you. So we'll see if it continues in October, November, but right now, really solid September and beginning of October for the country, and then kind of back to normal, a little bit down for December, but still a little bit ways to go. And I just want to real quickly, I know I don't see anybody on here from Europe or Canada or Mexico, but I just want to juxtapose that US curve versus this curve. And remember this curve in your head, because it's going to look like a lot like, unfortunately, the Hawaii curve as we start to get into the state and regional areas. But you can just see, really, without digging into any of the metrics here, just a much different story than what it's been in the US, which takes me back to where we started with the thanks to be in the position that we're in. You see here, even when you break it out and you look at countries like England, just depressed all the way across. A little bit of bump there in August in France, Italy, and Spain, but really just a down market across the board compared to the U.S. And finally, even in Canada, a little bit better in occupancy, but overall RevPar still what I would call, significantly down in the ditch and struggling to recover. So let's jump into the data that you guys care about. Most of you on the call are from either the West, Hawaii, Rocky Mountains, or the Southwest region, so that's what we're going to focus on today. I see Kate and a couple others that are from the Southeast. Go back and watch the data from this morning, or give me a shout out and I'll send it over to you, or Amy will as well, if you want the particular data for your market. But I'm going to focus on the West here and give you a little bit of detail about how that breaks down. So on this one, we're back to RevPar, and we've broken out Hawaii in blue, the Rocky Mountains, the Southwest, and the Western. And we'll focus on these three regions for a few slides here. And what you see is really just that US curve that we were looking at for RevPar broken out amongst these four areas. And Hawaii's pulled out for an obvious reason there. Just, the restrictions that are in place, our thoughts and prayers are with our friends out there who are struggling to keep their businesses afloat. And we're thinking about you. If there's anything we can do, please let us all know. If there's one thing I've learned about this industry, Amy and I were talking about it yesterday morning, is it's as if, you know, the whole industry kind of went to war together. And there's something that does about bringing people together, whether you're in competitive businesses or not. And it's been, it's been remarkably heartwarming to see how this industry has come together to help one another. So don't forget our friends down there in Hawaii, still, you know, beginning to climb out, fortunately, but still down there in the negative 75% for RevPar, and just not open. But if you look at the rest of the markets here, you can see the Rocky Mountain states in particular taking advantage of that kids out of school, September, and a real strong October as the weather starts to cool off. Western states as well taking advantage of September. Not so much West, they're still a little bit down for the next couple of months. So if you look at our eastern markets this morning, you know, all three of those markets we're seeing a significant bump in September and October. So you know, Southwest kind of standing out there in terms of not getting that same bump that these other markets are. All right, turning to year to date. So we're going to just take that same curve we looked at for RevPar, and we're going to split it into two different segments. The portion of the year that's already passed, the year to date in brown there or gray, and then the rest of the year in blue. And if you looked across our eastern markets this morning, with the exception of Orlando, which is so dependent upon Disney, and which also has, you know, the urban working against it, we really saw an incredibly strong rest of year, much like you see here in the center column for Tahoe. We're not seeing that quite as strong across these western markets. Of course, you see Hawaii's rest of year still significantly depressed, 59% for today forward. But even Jackson Hole, some of these, you know, world-class market destinations, 5% up for rest of year, which will take, 6% down for Northwest Colorado, and 4% down for Phoenix and Central Arizona. But it's important to take those in context versus the East Coast, where we're just seeing a little bit better rest of the year. And I don't know if that's an exodus from the urban markets and people who just want to be out of the Atlantas and the Houstons and the Bostons and the New Yorks, but it's certainly making a difference in those markets. And you would think you would see a little bit of that with people wanting to exodus, you know, from San Francisco and some of the larger urban markets out west as well, but not quite as much. So let's go back and look at the beginning of the year. I think this is a story that everybody's familiar with, and hopefully will be one of the last times we tell it. But if you look at what happened, it was really a reaction that was driven by policy decisions and lockdowns and openings that happened, you know, for many parts at a state level, but for other parts at a city or county level. But what we saw initially was really starting with March 9th, almost universally. We saw this immediate spike in cancellations. Everybody knows what March looked like and felt like. It peaked around 318 or 319 when we had everybody in our companies running cancellations, phone calls, and money was pouring out the door. And that was kind of the bottom of the barrel time for all of us. And we really didn't know if our businesses would survive. And then markets like Baldwin County here, reflected on the right in green, as soon as they opened, it answered the question that so many of us have been debating on these webinars that Amy and others have been having, which is, was the pent-up demand real, and was it there, and were the guests ready to travel? And it became clear immediately as these drive-to leisure markets opened that the demand was there, and they began to book, and they began to book really faster than what we could answer our phones in most of these markets. And they were booking for stays that immediately started the moment or the next day that they hung up the phone, for the most part. If you can see there in blue, and they would book on 5/1 for a stay on 5/1 or 5/2 or 5/15. And so a real compressed window where people were just ready to get out of the house, and they didn't know what it was going to be like in 2 weeks, but they were ready to come now. And so we saw that sharp rebound that we looked at in those first charts. In terms of bookings, as opposed to RevPar, you see kind of a similar trend here. A little bit of difference in the markets. The Southwest, not quite as compressed in terms of overall bookings there in April and May as some of the rest of the country, and the rest of the markets fared a little bit better and came out of the gate faring a little bit better, but really not seeing, you know, as strong of a jump there in July or August or September. So bookings are up, you know, they're probably more better stated as delayed, I think, than up, but about what we would expect for bookings given what we had been through for the year so far. Booking windows, most of the rest of the slides here, we're just going to tell the story of some trends that'll hopefully leave you with some takeaways. So lots of questions we get about what's going on with booking windows. And booking windows for the East, almost everybody saw this real steady curve that kind of looks like the Western United States or the Southwest there, like a big drop down where the booking windows became very compressed, like you see for the Rocky Mountain states there in May and June. And you saw, what this chart is illustrating, a loss of 40 or 50 days in the booking window, meaning if the booking window was 100 days, meaning people were willing to book 100 days before they arrived, they had all that confidence. In June there for the Rocky Mountains, you're losing 40 days off that booking window, meaning it's becoming 40 days more compressed, just reflective of the fact that people didn't have that confidence in terms of willingness to book a long ways out. They were still booking short-term vacations. Hawaii obviously acting much different and erratic because you've got a market that is essentially closed. So really just throwing off the curves here in terms of what the booking window would look for. And the people that are there are hunkered down for a long, long stay, as you can see, maybe finding a way to come in and stay for months as opposed to a short-term stay and affecting that booking window at the same time. Turning to
We can
link
add to that for a second. Do you mind?
Yeah, please.
So on the previous slide,
Yep.
so I was wondering, so you're looking at, October, November, December.
Mhm.
Are these as of dates? So we're looking at stays,
Let me
like,
think for a second to make sure I tell you the right answer, Amy. These are for arrivals on those dates, right? So a booking in December, if you look at just a December, for example, that's how long in advance did the bookings that we have on the books for December book. And so let's take one
that's
to
what I'm
make.
saying, are these as of the same date?
Yes, yeah. So Rocky Mountain State there.
2019. Okay.
Yeah. So December booking ahead, right? In other words, people are comfortable now booking out Christmas, for most of these markets except for the Western, at least as far out as they were booking them in previous years, right? So
Yeah, well, the reason I'm asking is that's different than what we're seeing in other platforms. So I just wonder if that's either pro managed inventory or these markets in particular.
I mean,
Okay.
yeah, my biggest guess, Amy, without digging into that data, which I will do every time you ask me a question, I try to go in and get the real answer. I'll tell you my guess right now is when we look at our scrape data set, we see, the only way we can define a booking window with scrape data is we see it was available today when we scraped it, and tomorrow when we scrape it, we see it's not available. And so we infer that that is a booking at that time, and it's a booking for, made a certain number of days in advance. The problem with that is if you're getting much different booking data from your scrape data, which is to be expected, it's probably because they're either holds or owner stays. And, when you're blocking off a hold, it's just, you can't count it as a booking window. So the only way to really nail your booking window is with a direct fed data set. And my gut tells me that's what's making up the difference. I would say on the booking window in particular, like in a lot of instances, it's just best to go to the real data as opposed to looking at the scrape data set.
So just if I'm in your system and I'm looking at my market, I can just pull these reports for my area.
You can, yeah. You can pull it for any neighborhood, any state, any handful of units. You can look at booking windows for houses with green golf carts if you want. We really try to customize it to where you can drill down. A lot of people come in and they just want to see high level. Like, I'm in Santa Rosa Beach or 30A or Watercolor. I just want to know what the booking windows are. But we get a lot of people who are kind of on the nerdier side and they're really trying to digest when to put that marketing out. And so they realize that a booking window for a big house in Watercolor is much different than a booking window for a small condo in Destin. And those are the people who are really optimizing things, right? I mean, you got people coming down last minute from Atlanta to stay in a 2-bedroom condo in Destin. And so it's okay to do last minute discounts. It's okay to put last minute flyers out there. But if you got a big 6-7 bedroom house in Watercolor or Rosemary, for the summer that you're trying to book. You can't, you got to know that that booking window is 180, 250 days, and you got to know that those are different. And so it's not okay to just say, what's the booking window in the Rocky Mountains? It's not okay to say, what's the booking window in Phoenix? You got to look within your market and within your property type, because they're going to differ fundamentally. And if you're not looking at the right data, you're not going to send your marketing out at the right time.
So let me just make sure I'm reading this right. Someone else asked this. That question was, so what is the booking window for the Rocky Mountain states year over year?
So this is looking at, this is not pulling the absolute value of the booking window for the Rocky Mountains as a whole. We could pull that on a slide, and it would say the booking window for the Rocky Mountains for all properties in the Rocky Mountains for December is 152 days, right? What this slide is showing it is what is the change in the booking window versus last year. So this is just the delta between
October. The booking window is 65 days higher than it was for October than 2019.
Yes. Yep, you're reading it right. Yep.
So
makes sense.
Okay.
And again, take the Hawaii data with a grain of salt. You're looking at a market close, right? But you can look at that Rocky Mountain, Southwest, or Western states. What you're reading is right. People booked the Southwest 30 days in advance for Christmas more than they did last year. Make sense?
Yeah, it does. So
Okay, same question.
I'm just reading some questions.
Same one. No, keep them coming. I'll jump to length of stay, but stop me anytime. We get way further along when we talk things out together, so I'm in it with you. This is average length of stay, right? Sometimes react kind of in concert with changes in booking windows. And so this is just, we look at every stay that happened in a particular market and how long did they stay. Again, Hawaii, if you're in Hawaii and you got there, you're not coming in and out, right? You got 14-day restrictions, you got lockdowns, you got some markets that are closed completely. I don't know all the nuances of the closures in Hawaii, so pardon me if I misstate something, but you've got the data acting fundamentally different. People are staying there longer than normal. You've got the rest of the markets, the Rocky Mountains, the Southwest, and the Western, all acting in concert together. And what you saw is if you were traveling during April or May or during the shutdowns, you were going and you were staying in place. And these are guest stays only, so it's pure data. There weren't a ton of those stays during those times that most of us were completely closed down, but the stays that were happening, people were getting out of city and they were going and staying for longer than normal, and that drove that delta over last year up by 5, 6, 7 days, as you see there in April. And then when you get back down to the rest of the year, starting in June, you're really seeing average length of stay on average that's a couple of days higher. It doesn't mean everybody that's coming in is staying a couple of days longer, and most of our 7-night stays or 8-night stays. If you look at a market like we're in and on 30A, right, it's still 7-night stays for the summer. The difference is you've got people like, my friend Jeremy Gall from Breezeway, he left Boston and he went and stayed in a vacation rental on the East Coast, and he stayed there for a couple of months, and that's skewing this data, it's moving that average up. So I think that's what's reflective here. A reminder, you got to go in and you got to dissect your market and you got to really pull it out, and it's going to differ by bedroom size and sleep size. But on average, we are seeing an increase in the average length of stay because people are coming and hunkering down and finding a location away from home to kind of ride out the storm, so to speak. Make sense?
Yep.
All right. An important slide to really understand the difference that we alluded to a second ago, Amy, kind of this difference between our scrape data and why we're careful about when we use that. Really great for supply, really dangerous if you're looking at just an occupancy figure. And so the important point I want to make with this slide is, total occupancy as we reported, it's really broken up and broken down into a couple of different components depending upon the occupancy figure you're pulling. You've got paid occupancy, or what a lot of people just call guest occupancy there in green. You've got owner stays or owner occupancy, and then you got holds. And the three of those combined add to a total of the off-market nights or the total occupancy. And so if you look at a market like Lake Tahoe, it's very illustrative of what we're dealing with here. It's showing an occupancy of 23%, right? And so if we looked at our scrape data for Airbnb or VRBO, and we saw 23% of the nights that were blacked out, we would say, oh, we got a total scraped occupancy of 23%. But when we dig into the real data that you guys are feeding us, we see that 18% is made up of holds, people who just blocked it off. Either it's locked down or there's an owner's weekend or whatever the case we're looking at. We were looking at June here. And so that's dramatically impacting that overall occupancy number. And so when you're looking and you're drilling down into occupancy numbers, make sure you know which one you're pulling. Are you pulling owner occupancies? Are you dissecting it down? Because paid guest occupancy is a much different figure than total occupancy. And I just wanted to illustrate that so that when you're diving into your data, you're making certain to look at the right data point. A couple of real quick ones. I know we're here on time, but some takeaways, right? Houses versus condos. Condos performed dramatically worse than houses for reasons you might expect, right? People just don't want to be jammed in a close building, just like they don't want to be jammed in a hotel. And we saw that, we expected it, and it's playing out pretty dramatically. You look at the Southwest there, condos down 21% in RevPar versus houses for that year-to-date change in RevPar. Same in the Rocky Mountains, same in the Southeast, same in all the Eastern markets we looked at this morning. And so you need to take that into consideration when you're pricing. If you're in one of these markets that's fortunate enough to be having a good a good fall, real good September and October, and you're looking at your rates, like you might be in a position where you can really push your rates on your house because the demand's there. Be careful about doing the same with condos, and certainly don't lump them together for your pricing decisions because they're definitely performing differently. Same thing here. This is a real colorful chart. What it's intended to illustrate is on the left-hand side, we've got ADR. So the higher the bullet, and each little color here represents a market. I don't have them all labeled. I want to illustrate the point. The higher the point there on the left, the higher the ADR. So another way to look at that is the higher it is on the graph, the more affluent the market is. The lower, down there near Panama City, an average ADR of 150. Those are our lower end markets, so to speak. And what you see is a general trend here that the higher the market or the more affluent the market, the better that they have performed versus last year in terms of RevPar across the bottom. Nobody's doing fantastic this year overall, but it's very worth noting that the affluent markets are seeing better travel. And this is the point Amy was making earlier that distinguishes it kind of from the hotel side. I suspect if you look at the hotels just for leisure travel, which is really what we're looking at here, not a lot of business travel in this data set, they would see the same thing, meaning the people who are getting squeezed are less likely to travel, and the people who are affluent and are better able to go stay in a super nice $420 a night place on 30A are less likely to get squeezed. And a lot of you may be asking how much of this could be, accounting for the fact that condos do worse because people don't want to be next to each other as opposed to, the economics of it. And so we pulled out houses in this slide and did houses only to take condos out of the equation. And the difference became even more pronounced. And so what this tells you from a takeaway is that if you're in an affluent market, you're seeing a better demand and you're a little bit more in a better position to push your prices. If you're in a less affluent market or even in a low end market, 100, 150, 200 ADR range for your average market stay, and particularly if you've got a heavy dose of condos in that market, you're probably not seeing quite the demand because of the economics that we're looking at, and just too many small businesses, too many restaurants shut down, and so you need to be more sensitive with your pricing. Couple final real quick slides here. Bedroom sizes matter, and they're definitely mattering in the September, October, November timeframe that we're looking at. As you can see, they usually don't matter with January through July with no appreciable difference. The reason we believe they matter now is because people are taking their families out of school, they're staying home from work and working, and they're sitting in a condo doing their webinars or reporting into work, and the kids are dialing into school online. And so the units that we see performing better this September and October, which is very usual to see this trend, are those units that hold families, 3, 4, and 5 bedrooms. The 6, 7, 8, 9 bedroom houses, not doing as well, still doing better than expected because people are fleeing the cities and taking some time to be with their families, kids while they're out of school and they're out of work. And 1 to 2 bedrooms, still doing good. Couples leaving the city, but not nearly as much as we're seeing for the families. Last couple points, and Scott and Patrick both alluded to this, so I'll skip past it quickly, but leisure markets just drastically outperforming urban markets, as I think all of you guys know for obvious reasons. You can see here kind of urban markets across the way. San Fran doing a little bit better there this summer, but just really not recovering like we're seeing in the leisure markets that most of you are in. Same thing that Scott alluded to with fly-to markets. They're just, Hawaii markets, obviously, for obvious reasons, are pulled down, but even your other markets, and traditionally a lot of those urban markets are the fly-to markets, but when you isolate those out, leisure drive-to markets just doing better. So sum it all up, last two slides. Who's not winning? It's the condos, the small units, the fly-to markets, the ones that have been shut down for long periods, obviously like Hawaii, and the urban markets. And if you're a one-bedroom condo in Honolulu, you've got the worst of everything. Conversely, the winners are the houses, privacy, right? Large units, the drive-to markets, the ones that opened up early have had a better year for obvious reasons, and leisure destinations. And then, as we pointed out, the affluent markets. So the 6-bedroom house in Watercolor is having a great year. Certainly not for everybody, so don't want to take that for granted. Shorter booking windows have pretty much returned to normal. Length of stays, the average is up just a hair, but returning to normal, and I think that's mostly outliers, markets where people are coming and staying for a long time. The best ones are affluent drive-to leisure, but my final reminder that I always offer to the point that Amy made, which is don't read a whole lot into high-level, regional, or U.S. level data. Each of your markets are different, and even within your market, a lot of the unit types are performing differently, particularly for 2020 compared to other markets. And so dig in and let us know if we can be of help.
Scott, are you still
That's
on?
it, Amy.
Yeah, I'm sure he popped off. So, by the way, anyone else, feel free to jump off. I'm going to ask Jason another couple of questions. And Patrick and Scott, thank you for helping us with this. Tomorrow is revenue management and pricing strategies. I'm excited about the panels that we have there, starting with Kelly McGuire, who is head of revenue for MGM Resorts. And it goes throughout the day until we start talking about homeowner contracts and how to talk to them about giving you the flexibility to change pricing. So we start at 10 a.m. tomorrow Eastern time, and I will see y'all tomorrow. If you want to hang out and talk a little bit more about data, I'm going to stay on for a second, but not long. So Jason, are you noticing a difference between owner-managed performance and professionally managed performance now that you're scraping data?
I think the answer is we're still early in our analysis. We're digging into it. I would rather wait and put some charts in front of you that answer that better than what I'll answer kind of on the fly is the short answer, Amy. I think you're going to see the early takeaways are that the ADRs tend to hold tighter with professional managed as compared to the RBOs, meaning when you see an instance like COVID, you see more of a willingness to drop units pricing in the RBOs than you see in the professional, which is I think what you would expect. But it's a great question that I haven't pulled the data in a little while. Let me send you something that you can send out with the workbook if you don't mind delaying the full answer to that.
Also, congratulations on the sale of your property management company. I know you said this means you only have one job now, but I know that you've been at it for 12 years, and it's a hard business. So congratulations on that.
Thank you. I heard Patrick at the beginning of his session say that Smith Travel or Star is proud to not be in any of the businesses, and I'm happy to say that now that we're just in the data business here to help you. Same as always, but it's making people feel a little better.
It is a fun business to be in.
It is.
Oh, that's right. I remember. I'd forgotten that they didn't like the fact that you had a property management company too. Yeah.
We're out. We're clean. Just in the data business.
So, like, is there anything that really surprised you at looking at the data after COVID? Is there anything that you expected to happen that didn't, or expected not to happen that did?
I mean, I think I was pleasantly surprised to see the spike we're seeing right now across most of the markets. You know, we were kind of curious to see whether it was really going to result in a strong RevPAR. I expected some kids that were going to leave Atlanta and the bigger cities, and they were going to come hang out in a few condos, but I didn't think it was really going to be a strong jump and kind of pay us back, so to speak, for the hit we took in the spring break markets, particularly in the eastern markets that are so dependent upon spring break. And then I'm really just surprised at how many markets have had a better year than last year on the whole. We got either at bankruptcy level or right approaching bankruptcy level for so many of our businesses. And I know some people are still dealing with that in Hawaii, and my heart goes out to them. But from, what a whiplash of a year. We saw all of us looking at what we thought was just going to be an abysmal year, and then it bounced back so strongly that you just got a lot of our customers that ended up with a 2020 that was better than 2019. And I never thought, until recently, that we were going to be in a position to say that. So, I think it's a hell of a space to be in a very awful time. And I think, for those who aren't necessarily in the leisure markets, I know you're going through a much harder time too, but most of the customers, most of the people tuned in here look like familiar faces from leisure markets in the U.S., and they've done better than anybody else in the world. And so a lot to be thankful for.
I was looking at, I wrote an article, we talked about it in December, about how recession-proof vacation rentals are. And the industry holds up so well in good times and in bad times. The problem is the profitability. It's the margins are so low. Yeah. And so we have a conversation with Simon Lehman, Andrew McConnell, Jim Olin, and Natalia Sutton from Vacasa tomorrow on profitability. And this whole idea of looking at this pricing and realizing that really where the business can become not just a business that does well during all these other things, during these times, but also a business that's, has a lot of growth and profitability is in revenue management. I mean, this is where we're going to find those extra, margin points. I'm wondering, and I don't know the way to phrase this question, actually. It's like, as people get smarter in this, do you think that it's a serious competitive advantage to be really good at? I know that sounds like a dumb question, but I mean, like, there are some people who say it is what it is. I could, I'm just going to spend a lot of money and time on this and it won't really move the needle. I'm wondering, as a property manager, as a former now property manager, if you think that revenue management and data will move the needle in our industry for profitability.
I think it's going to separate, those who make it from those who don't. When we started, it was the people who were great at marketing that just whipped the people who were bad at marketing, and I remember thinking that, the middle years of 360 Blue was just, if you were good at marketing and you could develop a great brand and you could pull away from the OTAs, those were the brands that made it and grew and distinguished themselves from everybody else. And I don't think any of us were good at pricing. I mean, and think about when Key Data started. I mean, the conversations we were having, we spent with you hundreds of hours on the road talking about what RevPar is and drawing lemonade stands and trying to figure out how to price. And now look at the conversations we're having at this conference that you're putting on today. It's become considerably more sophisticated. And so you've got Patrick and Smith Travel and all these big brands that are, Marriott, they're coming into our space and they're bringing really sharp revenue managers with them. And so you look at a lot of our big customers, they've got badass revenue managers on their team and they know what they're doing and they're really good at it and they know how to use these tools. And that's still the exception. But I think it's going to become the rule very soon. And it takes a little while for that to shake out. Like, it takes a year of putting up a good number for an owner to separate yourself from the guy down the road who put up a bad number, right? But I think that's where the difference will come more so than anything else. I think it's the new way to distinguish yourself, from the neighbor down the road. If you can consistently put more money in your owner's pocket, it takes a little time to prove that you're going to whip your competitors. And so I don't think we can afford to do it the way we've done it in the past. And I think there's an awful lot of businesses out there, ours was included, that had done fine, not being very good at pricing for 10 or 12 years or 20 years for some cases. And I think that's changing dramatically. You know.
I think too, there needs to be some kind of like, in the people who are doing revenue management, who have been doing this in the industry, some kind of recognition that maybe we don't know everything yet. I think if I were hiring someone in this space right now, whether it's an outsourced person or an in-house, I would want them to embrace the idea of being like curious and inquisitive and like I don't know the answer to this, you know what I mean? And not have that kind of, I don't mean cocky, I don't mean that, but you know what I mean, like this
Yeah, I
overconfident.
think we can afford to. Yeah, I mean, I feel like we're all learning together.
Yeah.
And when we started this, we turned all these professors out in the hotel space and top university folks, the people at Cornell, and we said, hey, come teach us how to do revenue management. We're about to teach the world, and we don't know what the hell we're talking about, quite honestly. And we were all kind of having these humble conversations amongst ourselves. And those professors and those experts in the hotel space said, man, your stuff's a lot different. Like our stuff doesn't work in your market. Yours is way harder. You're doing pricing for every widget at Target. You're not pricing.
Yeah. There is a question. Did you freeze?
And that's fundamentally different, and our models won't work. Say again?
No, I'm sorry.
So anyway, it's much harder, and I feel like we're learning it together. Oh, sorry. So, there's some people who are certainly setting themselves aside. Cliff's been doing this thing forever, and he can really drill down, and I feel like he deeply understands it. And there's some hotel people who are coming in that have deep expertise on the hotel side, but they're having to figure out the vacation rental side and how much harder it is. And so I think we got a long ways to go. I think you did a great job today with some of these panelists who are hitting us all where it counts, talking about how we've got to make benchmarking better, and we've got to come together as a group and start offering custom comp sets. In a hotel space, you can go out and pick who you want to create your comp set against. And you don't have to pick somebody in your neighborhood. You can pick another hotel across the country that performs a lot like you. And so I think as we kind of learn as an industry from each other, we're going to have to start to evolve into some of those more sophisticated tools and just be okay with the fact that, this data sharing and collaborative effort, or kind of co-op as we talked about it, is going to make us all better. But I think we're going to have to compete, or the big guys are going to come in and take business away from us.
I tell you why I really wanted to push that session on RevPar, and I probably should, in hindsight, have done it a different way. But the reason that we need to debate RevPar is because we have a lot of the revenue management service providers kind of adding some additional definitions and calculations on it. What concerns me is that RevPar can be an evaluation metric. So if your revenue provider or your revenue service provider is the one telling you what RevPar means, that meaning can be anything that makes them look good. That's what I mean? Like, you want some kind of apples to apples metric that's consistent across our industry so that we can evaluate performance in an apples to apples way. And that's why I would want to see us get there.
Yeah, I know you wanted everybody to kind of wrestle through those definitions today and see it live. And I still think that needs to happen. We could lock us all in a room and you could film it and we could get to the same result. We may need to throw some cocktails in like we were joking about, but we need to come together, right? I mean, Star set the standard for hotels 30 years ago and everybody followed it. And we've tried to emulate what standards they set from the hotel standpoint, but we do need to come together. We've got RevPar and RevPan and TRevPar and all those things. And I think that's kind of the second phase of us growing up together. I do think though that the conferences will force us, this conversation we're all kind of having today alone will force us all to go back and start to get in sync. And so I don't think you'll have another conference like this next year where we haven't gotten in sync. I think it's necessary, and I think you'll see it happen. We want the
There's
same.
A question here that I thought was really good. Is there an example of a fly-to leisure market that's having success, international or domestic? For example, any Caribbean islands who let travel showing, or is anybody showing positive signs that are fly-to markets? So hoping for some encouragement when the Hawaii government lets travel open up.
Oh, I'm sure my data team is listening in and raising their hand and yelling at obvious answers to me. I can't think of any right now, Amy. I mean, my hope is certainly that Hawaii will kind of act like your market in Orange Beach act, right, where the people were just anxious to get there. The challenge is how comfortable are they on airline flights. We're seeing air travel go up. I've flown Delta a lot the last couple of months. It feels safe. It's just whether or not there'll be enough of that travel to kind of fill those coffers back up. I don't know the answer to your question. I can't think of one off the top of my head.
I was looking at the attendees to see if anyone raised their hand to say they've got a market. I don't.
I'm trying to think. Caribbean's the right one to think of, right? I think you pointed it out.
Corinne just got back from St. John. She went for a month, 3 weeks, something like that.
I mean, the problem is a lot of those markets are still, finding themselves shut down with local policies. Bahamas is a good example, right off the east coast of Florida. Yeah, they opened up and they were full for a couple of months, and then they shut back down as COVID kind of hit them, and then the hurricanes hit them, and so the Caribbeans had their share of 2020, just like the rest of us. I
was going to say to our friends in Oregon that Australia, when we were on the call last spring, when we did the VR Intel Live and did the Australia and New Zealand group, they were coming off of their fires going into COVID.
Yeah.
And so it just feels like it's one. I was telling, I think, Betsy in an email, so it just feels like one wave after another of just hard things to deal with in our industry. And even though they're a guest, I mean, the fact is that still makes the business 24/7, 365. Like, it's a hard business to be in. And I wonder if you think that, like yourself, that we'll see some companies sell, not because of, I mean, just because it's a hard business, just because it's time to go. It's time to do something else.
Yeah, I mean, a fair question. I've heard a lot of people in the space that they survived, they did well economically, but it was just a lot, right? Like you hear people say, like, I'm tired of the fires, I'm tired of the hurricanes, I'm tired of the stress that comes with it. But I think our space is growing up right in front of our eyes. It's certainly been doing that forever, but it seems like it's accelerated this year, and it's just been an anxiety-ridden year. So I think that'll force some people to just reevaluate what, just like people are fleeing the urban markets to move down to the leisure markets. Like our houses down here and our boats, everything is selling like wildfire in a time where I would think nothing would be selling, and it's because everybody just wants to reprioritize. And so certainly I think this year we'll see some of that where what has traditionally been, no disrespect with the moniker, but what's traditionally been a mom and pop industry for so many years. You've got all these, professionals and big brands flooding into it and money flooding into it. And it's going to force you to decide, do I want to kind of grow up, and do I want to learn all this, and do I want to bring on a professional revenue manager? Do I want to start studying all this stuff? And is this really where my passion is? Or do I want to go, retire or do something else? And I think people are going to have to choose. It's certainly not going to be one of those instances where you can say, we built a great little mom and pop or family business here for the last 20 years, but we really never stepped up to the plate to figure all this out. And I'm sure we'll do fine. This will pass. I don't think it will pass. I think the professionalism and the knowledge are going to continue to kind of ramp up, and you're going to have to ramp up to stay with it. And so I think that'll drive some M&A business. I think
there's still buyers.
Yeah, there's plenty of guys with lots of money out there that want to get in this space. As a Jim Olin or Ben or one of those guys will tell you, they got a stack of them. That's just something everybody's going to have to look inside and decide whether they're in it for the long run or this is a good time.
If you want a magazine, I've got one for sale. Okay. I will, thank you guys so much. I appreciate you sticking around on a hurricane night and talking me through this. I think I'm just too scared to turn it off. At least now you guys know where I am.
That's right.
I really enjoyed today. I've learned a lot from today. One of the people that stands out to me was Dr. Noon from Penn State, just giving us an academic view of all this stuff. I thought was really valuable. We need to find a way to bring her back in. Thank you, everyone. I'm excited about Strategy Day tomorrow and followed by Tech Day on Thursday. And Thank you, Jason, for all your work today and to be on pricing and AirDNA and all the data guys that helped us out in STR. I really appreciate it. And we'll see you tomorrow morning. Have a great night.
See you tomorrow.